everyone, I'm Corraine and welcome back to my channel at Choo Realty. Around this time every year, the market gets tested by something new. Last year, people were worried about tariff tensions. Before that, it was the Russia-Ukraine war. And now, once again, the world is facing new geopolitical uncertainty with the conflict on US, Israel, and Iran. And of course, rising oil prices. So if you're feeling unsettled, you're not alone. But here's what I want to say. While the world may continue to experience instability, Singapore's property market was never built to behave like a reckless speculative market. It was built to be resilient, sustainable, and most importantly, affordable for Singaporeans over the long term. Most people are looking at the market right now and asking the wrong questions. If you're still waiting for the right time to enter the property market, there's something you need to understand. The biggest opportunities don't appear when the market is clear, because beyond the noise, beyond the headlines, and beyond all the fears circulating in the market, there are still very clear opportunities, and most people don't know how to read it. So today, I'm going to break down the top 5 biggest concerns in the market right now, and more importantly, show you what they really mean for you, whether you're a buyer, seller, upgrader, or an investor. Before we begin, remember to like, share, and subscribe to my channel at Corraine Realty. This will really motivate me to create more content for you and coming forward for one-to-one consultations. Thank you sincerely. I truly appreciate it. A lot of you have told me that my videos help you see the market from a different perspective you have never thought about before. And I genuinely appreciate that, because that's exactly the purpose behind what I do, to help you filter out the noise and approach your property decisions with clarity and confidence. So let's begin into today's topic. Concern number 1. New launch prices are inching up. Should you wait or should you enter now? This is one of the biggest concerns in today's market. And my answer is this. The GFA harmonization opportunity window is closing. When GFA harmonization was first introduced in September 2022 and took effect in June 2023, developers were cautious. There was uncertainty in the market. They were still trying to understand how to design projects under the new URA guidelines, how consumers will respond, and whether these harmonized layouts would be well received by the public. Because of the uncertainty, land prices softened. As you can see here, from 2022 to 2024, it dropped from 1,298 per square foot to 1,131 per square foot, and thereafter, it rebounded to 1,249 per square foot, forming a V-shape here, or as we call it, buying into the dip. So what happened? From 2022 to 2024, this was a phase where developers were hesitant, and that hesitation created opportunity. The earlier plots of land sold during that period came in at lower land costs. That gave rise to the first batch of projects riding on the first mover advantage of GFA harmonization. Fast forward to today, the uncertainty is no longer there. Developers understood the framework, the guidelines, and how buyers are responding. And with that clarity, it restored confidence back into the market, which is why we see land bids have turned noticeably more aggressive again. This clearly marks the end of the GFA harmonization advantage, because we are seeing prices rebounding and normalizing back into its usual higher trends. So the question is no longer, are prices inching up? The more important question is, can you still capitalize on projects that were bought on lower land costs before the sharp rebound happened? And the answer is yes, but the window of opportunity is narrowing. Here, I have a full chart of the land prices of the recent projects to help you better connect the dots. 1 Marina Gardens, Lentor Central, Sky Holland, Alta, Ori, Nava, Bloomsbury, Zion Grand, Springleaf Residences, Promenade Peak, The Sand, Tengah Garden. All these mark the low prices arising from the GFA harmonization effect. These were the first and second batches of land sold, influenced by the policy, and we are reaching the end of this opportunity with Nara, River Modern, Villa Bay, Lantern Gardens, and also Hudson Place. Of course, this is a broader, bigger picture before the prices rebound from the V point. Now, by the time we hit Lantern Gardens, it was April 2025. The land sold from June 2025 onwards actually experienced an exponential growth of 20 to even 40%, as evident by the Holland plot at 1,410 per square foot, followed by 1,432 per square foot, Upper Thomson, Dorset, Bedok, Newton, setting a new benchmark, and Tanjong Rhu. You'll realize one thing, lands sold after June 2025 are 20 to even 40% higher, and these land bids are generally launched about 1 year later, so we're expecting to see them coming up from June 2026 onwards. Does this mark the end of the GFA harmonization advantage window? To put things into perspective, as a comparison, we can see here the CCR lands, Holland and Dunnan, comparing to Zion Grand and Promenade Peak. They are 20% higher. Upper Thomson is 17% higher than its counterpart, Springleaf Residences. Dorset and Bedok is already about 150 to 200 PSF higher than what Zion Grand is. Newton at 1,820 per square foot is 600 PSF higher than Zion Grand, and Tanjong Rhu is also about 200 PSF higher than what Zion Grand is. That is why I always say, don't get distracted by small price movements and miss the bigger structural opportunity. Can we still capitalize on the advantage of the early land sales from GFA harmonization? If Alta, Bloomsbury, Nava Grove and Zion Grand land price versus their average sale price is as shown in the slides, how much do you think will be the average price for Bedok, Dorset and Holland Link, given the higher land cost? Because if you're still able to buy the projects that will launch off land required before the major rebound, then you're still benefiting from the earlier cost advantage. That is the window of opportunity, because you're still able to enter before the full impact of the newer, much higher land prices start flowing into the launch market. So to me, this concern is not a reason to hold back. It's actually a reason to act with more clarity. Yes, prices have inched up, but in many cases, you're able to buy into projects before the next major pricing uptrend. And once the next wave of projects from the higher land cost era starts launching, today's prices may no longer look expensive in hindsight. So if you're buyers still sitting on the fence, my view is very simple. Enter into the market while this final window of opportunity still exists. Do not make the mistake of being too nitty-gritty with the small numbers and miss out on this golden window of opportunity. Concern number 2. Resale transactions are slower, especially for newer resale condos. Now, let's talk about resale. This is where many owners are feeling the friction, because while overall resale activity may still look resilient on paper, the reality on the ground is more nuanced. Not all resale properties are affected equally. If you own an older resale development with a bigger floor plate and a substantial amount of price gap exists between you and the new launch, there will still be inherent demand. Why? Because for many buyers, that price gap still makes sense if it meets their housing needs for a bigger place and it still feels affordable relative to alternatives. Based on the statistics, in 2025, we do have 14,622 on resale units sold, slightly higher than in 2024. But I know for some of you who own a resale unit, you might not feel that way. Let me address this. First of all, if you own a slightly bigger unit but in an older development, the price gap is there between you and the new launch in the current market, or even in the newer resales. But if it's suitable for them in terms of room type and affordability, Singaporeans would generally still go for it for their own stay. But if you own a resale condo that TOP'd within the last 5 years, then you're in a very different position. Why do I say that? Because now you're competing more directly with harmonized new launches, and this is where the pressure comes in. Here we have Sterling Residences, which is a non-harmonized project, and Penrith, which is a new launch under GFA harmonization. Under GFA harmonization, developers have become much more efficient in creating units that feel usable, livable, and family-friendly, while keeping the overall quantum more manageable. For example, Sterling's 2-bedroom is 624 square feet to 904 square feet, from $1.32 million to $1.98 million. 3-bedroom is 883 square feet to 1,281 square feet, from $2 million to $2.78 million. 4-bedroom is 1,346 square feet, from $2.06 million to $3.55 million. Paris 2-bedroom is 614 square feet to 678 square feet, from $1.44 million to $2.06 million. 3-bedroom is 786 square feet to 1,066 square feet, from $1.97 million to $3.22 million. 4-bedroom is 1,173 square feet to 1,281 square feet, from $3.07 million to $3.907 million. Because Sterling Residences is a non-harmonized project, the unit size includes the aircon latch, while Penrith is a harmonized project, so its unit size does not include the aircon latch, which is typically about 70 to 80 square feet difference. But do you notice one thing? The starting price of a 3-bedder for Penrith is $30,000 cheaper than Sterling Residences, despite Penrith being the new launch. Same thing for the 4-bedroom, because of better design and efficiency from the GFA harmonization. Developers managed to build a proper 4-bedroom compact that still meet the needs of families, giving good space and good livability. With that in mind, you realize if I ever need a 4-bedroom option, I don't really have to pay for someone else's profit to go for resale. I can get something brand new instead, when the new launch price is so similar. However, it does have an opportunity cost in terms of the construction period as well. So buyers will have to weigh out your options. Same thing for Sky Holland versus One Holland Village. Because of GFA harmonization, the average price for Sky Holland is $2.893 million as compared to One Holland Village at $3.275 million. Because of GFA harmonization, it lowers the overall quantum, driving today's affordability back to yesterday's pricing. But do you see? From a buyer's perspective, the comparison becomes very real. They may look at a newer resale unit and ask, if the quantum is similar, why should I buy resale when I can buy brand new? That is the competitive stress. And that is why some newer resale owners are struggling more than expected in today's market. The issue is not that their property is bad. The issue is that the market has changed. The consumer now has a new option. And if you are not priced correctly, you feel the resistance. To further support this, let's take a look at Lentor Modern. It was launched in 2022, the first project introduced in the Lentor Township. Everyone was a bit skeptical, but kudos to those who made the right choice by entering. If you see the transactions, the subsale has already happened. Let's use this unit as an example. At 990 square feet, if we harmonize it, the equivalent will be at 930 square feet. It was sold at $2.408 million. The same owner can enter into Penrith, a harmonized project in RCR at 936 square feet with a price of $2.439 million. At OCR Resale at RCR New Launch Quantum, contrary to the usual scenario where if we sell a 3-bedroom OCR development to move closer to the city, we will have to pay a lot more to get back a 3-bedroom or sacrifice a bedroom and can only get a 2-bedroom unit using the same price or quantum from the proceeds. Because of this change in policy for GFA harmonization, can we protect the quantum and still upgrade closer to the city without compromising on the bedroom classification? Right now, we have this very clear opportunity in front of us. You can sell an OCR Resale 3-bedroom compact to buy an RCR New Launch 3-bedroom compact at the same quantum without dropping on your bedroom classification or any compromise in terms of size, layout, and livability. Another example, Park Colonial with Sky at Holland. Park Colonial 936 square feet, if harmonized is 890 square feet, so at $2.325 million. Can the owner upgrade to Sky at Holland, harmonized 3-bedroom, 915 square feet at $2.394 million, a RCR Resale at CCR New Launch Quantum? Can we actually protect the quantum and make this upgrade? Can we capitalize on this? Here is where I want all resale owners to shift their mindset. My advice is, don't just focus on how much profit you want to make. Focus on what opportunity your current asset can unlock for you. Sell high right now because you would already have the few $100,000 profit. Swap and renew your assets from non-harmonized to harmonized because that is the way you can sell high and buy back into the low. Low in what sense? Usually, if you want to move closer to the city, you have to compromise. You either drop a bedroom, accept an older resale, or top up more in cash. But because of this transitional period created by GFA harmonization, there are now windows of opportunity where you can actually renew your asset, upgrade to a better location, gaining better value without compromising on the bedroom type, livability, and size. Of course, you do not need to slash your price recklessly, but if a small 1% to 3% adjustment help you to edge out your direct competition, offload faster, and secure the next opportunity before the window closes, that may be the smarter move. Because if you wait too long, you may think you gain from the sale, but actually you lose out on the bigger opportunity. And in property, opportunity costs and waiting costs are real. Concern number 3, HDB price growth is slowing. What does that mean for owners? This is a very important one because if you have been watching the HDB market closely, you'll notice that the growth momentum has clearly softened. As you can see from here, after the sharp growth in the earlier years driven by supply shortages and post-COVID demand distortions, the market is now entering a different phase with the growth from 1.6% in Q1 2025 to 0.9% in Q2 to 0.4% in Q3 and finally hitting 0% in Q4 2025. Subsequently, dropping 0.1% in Q1 2026. For the first time in close to 7 years, we see HDB resale prices decline. The last quarter-on-quarter decline in resale prices was recorded back in Q2 2019. Isn't this a clear indicator that HDB resale prices are exhibiting early signs of price correction and consolidation? Supply is coming back into the HDB market. In January 2026, HDB announces more BTOs are being launched. Immediately in February, HDB launches 9,012 flats, including prime projects in red here. Another one, HDB launches 1,600 flats in Lakeview and Shunfu, the first supply in 40 years, all of which is aiming at the target of 55,000 units from 2025 to 2027. Additionally, an influx of MOP flats in 2026 could further moderate resale prices. Largest projects include Alcaf Oasis, 1,594 units, Tampines Green Verge, 2,022 units, Bedok Soft Horizon, 940 units, Sky Residences at Dawson, 1,217 units, Sky Oasis at Dawson, 1,188 units. Total units, we have 13,480 units, and the government has always been very clear that they want to moderate resale price growth to keep public housing affordable. This is not speculation. On one hand, we have multiple BTO launches with some having shorter construction time, and on the other hand, we see more ready MOP units in the market. Basic supply and demand logic, with supply ramping up but demand normalizing. What will happen to the price? In fact, the 0% flat-out growth is it an indicator that HDB resale prices are reaching its peak and may then decline from there? You can see from the graph the HDB prices in terms of trend line. broken down into different room types: 3-room, 4-room, 5-room, and executive apartments. As you can see, across the board, we can see the trend tapering out and hitting a plateau. In fact, we are seeing a slight drop in prices for the 5-room and above layout types. So if you are a HDB owner today, especially one planning to upgrade, what is the most important thing when it comes to upgrading? Yes, your cash proceeds. Because when you upgrade, cash is one of the most important components. It affects your next down payment, your flexibility, your loan structure, and ultimately, what kind of next asset you can move into. So if the market is flattening and more supply is coming in, then the key question becomes, do you want to make a controlled price adjustment now or let the market adjust your price later on? Because if you proactively adjust by a small margin now and secure a sale, you preserve time, preserve control, and preserve your upgrading options. But if you wait and the market softens further, you may end up losing more than just a few percentage points. You also lose time, flexibility, and access to the current private market opportunities that still exist today. So for HDB owners out there, my view is this. This is not the time to be stubborn. This is the time to be strategic. If the signs are already showing that prices are flattening, and if upcoming supply is likely to apply more pressure, then acting early may be the difference between upgrading comfortably and upgrading under pressure. Concern number 4. Can people still afford property if new launches prices keep rising? This is the question every generation asks, and yet every cycle, the market finds its next level. Why? Because affordability is not just about headline price. It is about the relationship between income, policy, financing conditions, and housing demand. Singapore's market does not operate in isolation. It is heavily managed, heavily calibrated, and constantly buffered by policy. That is why over the years, the government has introduced round after round of cooling measures, financial controls, and affordability safeguards, not to crash the market, but to keep it sustainable. And this is the part many people miss. The Singapore market today is no longer driven mainly by reckless speculation. It is driven by the concept of housing as a need. First of all, if we have to understand the population growth in Singapore, over the last 5 years, our population grew from 5.43 million to 6.11 million. What we have to focus on is the red and green portion, which are the citizens and the PR. Over the last 5 years, we grew 160,000 new citizens and 50,000 PR. Coupled with the recent news from Budget 2026, every year, the government aims to bring in 30,000 to 50,000 new citizens and PR for the next 5 years in line with the population white paper, as well as to maintain the GDP growth and economic sustainability. So this is where the demand is coming from. Just remember this magic number of 210,000. If we divide by the average household number of 3.09, we will need 67,961 units. The new launches slated for completion in the next 5 years are only 44,208 units. The question you may be thinking is, all these households, not everyone is going for new launches. Yes, this is correct to a certain extent. But do not forget, can PR buy HDB? New PR have to wait 3 years each before they're eligible for a resale unit. They're not able to go for BTO and they are subjected to ABSD, be it whether they're buying a HDB or private. If you think about it, new PRs are awarded because they have significant income contribution, right? So, would they want to wait and still be subjected to the same or even more stringent measures by the HDB, or would they prefer to own a private with lesser restrictions? As for new citizen, in order to become a citizen, the income contribution would be higher than that of a PR. And yes, you'll be able to go for BTO. However, given such a scenario, most of the time, these families are earning a higher than average income, which will also highly likely exceed the HDB BTO income ceiling. Another cyclical effect is that out of these 67,961 new demands, not everyone will be going for new launches, some will be going for resale. When the new citizen or PR buy a resale unit, it also means that the homes of these resale owners were displaced. After all, they will need a place to stay and will end up having to purchase another home for themselves. So, am I right to say that we will always need a new supply of houses coming in to keep up with the demand? And when housing is positioned as a need, the question changes. It is no longer, would someone want to buy? It becomes, can someone afford to buy what they need? And as long as the system is built in a way where income policies, loan frameworks, and housing assets are aligned, there will continue to be a natural buyer pool. Do not judge affordability by the price alone. Judge it by the ability of the people who are able to support the take-up cost for their own needs. Here is the comparison between property prices versus the household income. The blue line is the property prices and the red line is the income representation based on GDP. How do I read this? All of us can agree that looking back, property prices was cheap during our grandparents' time. But if we factor in the income affordability, the red line is lower than the property price. There is real concern and fear that if I buy a property back then, will I be able to hold it, and whether will I be able to exit when I need to liquidate it, because the general society may not be able to afford it. This persisted all the way into 2006. You will see in 2006, the two lines intersect each other, and there we see property prices start to boom. But later on in 2008 was the Lehman Brothers, and there were many fluctuations along the way. Because of these fluctuations, our government did not want to make the market so susceptible to external economic factors, and that is when cooling measures were introduced. Until today, we have more than 20 rounds of cooling measures already, creating a strong buffer in the market today. A further read into this graph is that we must understand pre-2014 and post-2014. Pre-2014, the government is focusing on attracting foreign companies, foreign investments, and even foreign talents into Singapore. It is focused on growing Singapore's GDP. Then post-2014, the government's vision shifted. Singaporean needs come first. Buy property as a need. What is a need? Let me give you an example. Woodlands may not be the best location to majority of the people, but it achieved $2,000 per square foot for Nauru Grand. I was also scratching my head, but we have to understand that it is a need. People need to stay near their parents, near their workplace, near their children's school. I need all this. If I can afford, naturally, I will buy, which is what is reflected here. The red line, which is the income, is higher than the blue line, which is the property price, starting from a narrower gap until now with a wider positive gap. Willing buyer, willing seller. That's why we see CDL launching non-grant at an average of 2,067 per square foot and still achieve a whopping 84% sold on launch day. Moving forward, property prices will continue to head up with increasing land prices, construction costs, materials, and labor. But the earlier fear that people would not be able to afford housing has largely diminished, as long as cooling measures and income policies remain effective in maintaining a sustainable gap between income levels and property prices. 4 years ago, there was a crisis. What is this crisis? Yes, COVID. As we can see here, due to the slowdown of the economy, the GDP declined quite significantly. But because of this wide buffer, we actually have time and resources to tide through. When there is a need, people still have to buy for their own stay. And that is why you see this blue line climbing steadily despite the drop. The gradient of this graph before COVID was much gentler. After the dip, look at how fast it rebounded and the gradient of it. The government recognized the need to support and stimulate the market. Policies were rolled out to keep affordability in check. However, with manpower issues and delays in completion, while the need for housing is still there, that is why we see prices pulling away. Next question to ask is freehold a need or a choice? It is actually a choice. That is why we see consumer behavior change recently. Because of this affordability gap, you'll realize that if you are here, you're not even certain if the general society is able to afford it. So our parents' generation or grandparents' generation believe that they should get a freehold in order to preserve their capital. Since it's not so easy to find someone else to buy from me at a higher price, I might as well hold it all the way. So will the future generation be able to afford it? Do you notice HDB prices have gotten higher and higher over the years as well? Typically, HDB award contracts based on the affordability of Singaporeans. It is tagged to the median salary. Do you also remember this article by Morgan Stanley in 2017, where it says that Singapore's property prices will double by 2030? It implies a 5% to 6% per annum increase. Everyone was pretty skeptical about this piece of news. Look at what has happened. Along the way from the article till now, we have grown by 65.31%, translating to a 8.16% growth per annum. That itself is already more than what the article has projected. Will history repeat itself? I'm sure that before Straits Times published this article, careful and detailed research would have already been done. Increased affordability, coupled with the GFA harmonization, helped many Singaporeans own their home. An example is Tembusu Grand, a non-harmonized project, launched in April 2023, and Emerald of Katong, a harmonized project, launched in November 2024. About a 1.5 years gap. By right, a new launch that launched later should cost more than the new launch that was launched earlier. But look at the prices. For one bedroom, both started at $1.24 million. For two bedroom, Tembusu Grand, $1.589 million versus EOK $1.558 million. For three bedroom, EOK $2.167 million versus Tembusu Grand $2.28 million. Four bedrooms start from $2.74 million versus $3.288 million. And the five bedroom for EOK start from $3.59 million versus Tembusu Grand of $4.16 million. Didn't we just went back to 2023 pricing? So, if you were to translate this into the graph, you can see that our affordability is here, but yet bring you back to 2023 property prices. Doesn't that mark a key opportunity window that you want to capitalize on? Concern number 5. Will ongoing global conflict affect Singapore property prices? This is the concern that is sitting in many people's minds right now. And let me say this carefully. Global conflict absolutely affects sentiment. It affects confidence. It affects the headlines. It affects how people feel. But whether it affects Singapore residential property prices in a major structural way is a different question altogether. And my view is this: Singapore's residential market today is far more buffered than many people realize. Looking back at the same graph, we are seeing one of the widest possible gap between the income/GDP versus the property price. Given such a wide gap buffer, if ever the external market factors were to affect Singapore's economy, causing detrimental issues and many high unemployment rate, which will result in a drastic drop. Am I right to say that the government will not wait until it drops all the way before taking action? By having such a wide buffer, it gives all of us and the government sufficient time to react and come up with pragmatic policies to stimulate the economy or the property prices. There are already more than 20 cooling measures in place. During such times, can the government relax certain measures to overcome the challenges to keep income in line with the market? I believe that this time round, the conflict will not cause a severe detrimental effect to our property prices. Why do I say that? Because of 3 things. First, we already have years of cooling measures and policy safeguards in place. Second, our market is predominantly supported by local owner-occupied demand. Third, housing here is treated fundamentally as a need, not speculative. This is because speculative markets are highly sensitive to fear, which can trigger sharp exits. In contrast, when the market is anchored by genuine housing demand, the fundamental structure remains stable. A family still needs a roof over their head. An upgrader still needs their next home. A newly married couple still needs to buy. A household that has outgrown its current space still needs to move. That need does not disappear simply because there's a conflict elsewhere in the world. Of course, if macro uncertainty becomes severe enough, sentiment may soften. Buyers may take a little longer. Some buyers may pause. Some buyers may become more cautious. However, in Singapore, the structure of the market, the governance, the financing framework, and the policy buffers are all designed to prevent disorderly behaviour. So when I look at current geopolitical tensions, I do not automatically see a reason for panic in Singapore's property market. What I see instead is this: in times of uncertainty, many people naturally move towards real tangible assets, and property, when bought correctly, remains one of the most powerful ways to preserve capital over the long term. My final verdict: so what should you do? Let me wrap everything up clearly for you. If you're a first-time buyer, the GFA harmonization advantage window is narrowing. The earlier you understand it, the better position you are to act before the next pricing reset drives prices upwards. If you're a newer resale condo owner, do not be overly fixated on squeezing out every last dollar, as you might miss the chance to renew your asset and reposition yourself better in Singapore's property market. If you're a HDB owner planning to upgrade, protect your cash proceeds. Do not let the market make the adjustment for you when you can still make a controlled and deliberate move now. If you're worried about affordability, understand that Singapore's system is built very differently from markets that are purely speculative. Price is only one part of the equation, and if you're worried about global conflict, then understand this: sentiment may shake, but structural demand does not disappear overnight in a market like Singapore. So, overall, my conclusion to you is this: this is still a market of opportunity, but only for those who can recognize where the real window of opportunity is. Not every buyer should buy anything blindly. Not every seller should sell without a strategy. But if you can connect the dots properly together, there are still very clear moves that can put you in a stronger position over the next cycle. And that is exactly what I help my clients to do. To understand why now, why this asset, and why this move, and what this move unlocks for them next. If you have found this video valuable, remember to like, share, and subscribe. And if you want someone to help you connect all these moving parts to your situation, whether you are buying, selling, or upgrading, or just trying to understand your next step, feel free to reach out to me, Corraine, at 88-826-826 directly for one-to-one consultation. I'm Corraine Choo, your trusted real estate advisor, helping you navigate every property move with confidence and clarity. Once again, this is Corraine Choo Realty signing off. Clarity, strategy, results. I'll see you in the next video. Bye!